Well, thanks so much for tuning into this conversation with arguably somebody who is amongst the largest names in the investing fraternity on the global front. Rishi Kapoor of Investcorp with us on NDTV Profit. Rishi, thanks so much for taking the time out and speaking to us today.
Look, Niraj, as always, it's a pleasure being with you all over here.
Thank you. So, Rishi, how is the world of risk assets looking like in 2024, considering the fact that the narrative is of higher for longer rates, but in a year where we might, or we definitely will, see interest rates coming off from the peaks?
So I think you framed it well, Niraj. It's all about the narrative, because the narrative initially at least shapes sentiment, and then sentiment eventually will result in decisions being made by people like me and others, that are here and all over the world, and those decisions in turn drive outcomes, right? So let's take a step back. What has changed in 2024 and in the lead up to 2024, I would say? I think the main change that I see is not necessarily the fact that interest rates might, decline precipitously over the course of the next, few months or even the subsequent year or so. It's actually the narrowing of the bands of uncertainty around the direction of rates. What I mean by that is the following. Heading into the early part of 2023, there was a lot of uncertainty around where will rates peak, how long before we get there, how fast is going to be the pace of hiking, and will there, as a consequence, be the potential for a recession or certainly a hard landing for the US economy, broadly speaking, but also beyond that, the spillover effect on the global economy. And I think where we stand today, a year hence, is that whilst it is entirely plausible that rates might stay high for long, I'm not using higher for longer, I'm using high for long, but the bands of uncertainty around that level of long-term rates is narrower. And that informs risk-taking and decision-making, right? People like us that are in the business of deploying capital across multiple asset classes all over the world, the one thing that we are most fearful of is uncertainty that is difficult to underwrite, right? We are in the risk-taking business, so some level of uncertainty obviously is taken for granted. Yeah. But beyond certain boundaries, acceptable guardrails of uncertainty, it gets difficult to generate the kind of conviction that you need to deploy capital. And I think the narrowing of the bands of uncertainty is very constructive for risk assets, but more importantly, for the ending of that funding winter that we were talking about last year, if you recall.
Yeah, so in some sense, are you a lot more confident and more certain an investor at the beginning of 2024 than what you might have been at the beginning of 2023?
23, certainly we were tentative, no doubt about it. Now, as it played out, 23, particularly in the public equity markets, was a great year.
Yes, exactly.
Right? And we've had some great outcomes ourselves, right? In our portfolio, in India, the portfolio that you are most familiar with, we had a fantastic outcome with Safari Industries, almost a 4 times money on money return over there. That's nothing to be embarrassed about at all, right? That's a fantastic outcome. But notwithstanding how the year actually played out towards the second half in particular, the final quarter, our demeanor, our stance was cautious, prudent, right? I'm not suggesting that we are entering 2024 abandoning all of that prudence and caution. All I'm saying is that we are more constructive about the outlook for true fundamental growth and value creation, devoid of the extremities that are driven by monetary policy. Right?
Got it.
The direction and pace of monetary tightening is something that we are more kind of sanguine about now than we were 12 months back.
Somebody give me an acronym in 2023. Maybe it didn't turn out well. It didn't age well for sure. Person said we are moving from a zone of TINA to TARA, which is there are reasonable alternatives. But is it true now for 2024 that from there being no alternative to equities, there are reasonable alternatives now for 2024 and beyond?
Depends on what your horizon is, number one. What I mean is investment horizon. And number two, which markets you're focused on. So even for most of 2023, despite the fact that there was abundance of caution in terms of deployment of capital into equities early on, credit was a fantastic space to be in, right? I mean, you were getting equity-like returns in private credit, and I think as we sit here today in January of 2024, looking ahead over the next 12 to 18 months, that more constructive backdrop for private credit continues to play out. So definitely, is there a real alternative? Yes, credit is a real alternative. Real estate should bounce back with the stabilization of the direction and trajectory of interest rates, because what you need is price discovery. And I think what was missing in 2023 was an unwillingness on the part of buyers and sellers to converge on a price point where they could transact. Now I think that price discovery is likely to happen. And private equity, as we alluded to earlier, I think now with the general outlook being of sidelining the idea of a likely hard landing or a recession and focusing on a narrower range of outcomes, which may be a soft landing, maybe a no landing, where you continue to power ahead with 2.5%, 3% growth, that's actually very constructive for private equity. Long-term value creation is pretty much the name of the game for the next 3 to 4 years.
Any view on public equities, more so India, simply because of the fact that it seems to be the cynosure of many eyes, but the valuations out there are maybe a hitch, though the bull would argue that valuations in India have always been expensive, so this is nothing new.
So, I've gotten into a little bit of trouble with my colleagues and friends for proclaiming on occasion that investing in India, particularly in equity markets in India, is not for the faint-hearted, right? And the reason for that is very simple, precisely what you said, which is valuation multiples that we get used to dealing with in the rest of the world, basically end up defying gravity when you come to India. But you're also right in that, that's always been the case, So ultimately for us, when we think about how we shape our investment strategy for the equity market in India, we are not in public equity, right? But being in private equity, what happens in the public markets is very relevant for outcomes in terms of exits and monetization for us. So the way we shape it is we say, let's accept the fact that we are going to pay a premium over average multiples globally in India for a company that is similarly in a premium segment and has that premium level of performance. So it is much more a micro assessment of the sector, the industry in which the company is, and its actual positioning within that industry or sector, its management team, its vision, and its go-to-market strategy, including its cost structure and its efficiency levels, not just about naked growth, right? I think that, tide has run out. That growth at any cost is not really a supportable business value proposition when it comes to private investing. It's much more about proving your unit economics and positioning yourself such that you have a truly valuable business value proposition from the get-go, that you can grow, enhance, scale up, hopefully exponentially at higher than market rates, and then monetize, right? And I think from that perspective, if you stay disciplined on those few areas that I outlined, guess what? You are going to get that premium multiple on the way out as well. And I think that's where we make ourselves somewhat agnostic to the multiple that we are paying on the way in, because we think that we can monetize it at the same multiple on the way out.
Got it. My final question, Rishi, and that is on the flows to India. Now, there's a lot of talk about how, people tell me that ex-China funds are getting tremendous flows because people are, to an extent, maybe disillusioned with some of the things that are happening there. But that notwithstanding, it's not a market that you shrug away. But my limited point is, still in the near term, do you think markets like India and some others, of course, benefit out of investors maybe having a little bit of a cold feet when it comes to investing truckloads into China?
So can I be slightly controversial?
Please do.
In terms of responding to that? I am a firm believer in the absolutist view rather than the relative view. And what I mean by that is, we are a $3.5 trillion economy, right? Our market cap is actually slightly higher than 100% of GDP, right? And we are at that inflection point in terms of GDP per capita where the level of affluence ought to grow. On an absolute basis, therefore, India should get its fair share and more of the capital flows, right? It is not about reallocating, it is about an absolute level of capital flows. Because it demands it, there is a need, and it commands it because the fundamentals are in place, right? You have a young demographic, you have a digitally native population, you have growing levels of affluence, you have a growing middle class, you have two major secular trends shaping the global economy, both of which are supportive tailwinds for India. The energy transition and the embrace of digitalization and artificial intelligence. India has been called, I think perhaps wrongly so, the back office of the world because everyone wanted to call somebody else the factory of the world, right? But what does back office actually mean? We have the knowledge workers. But what do you think is going to be the sector that is most beneficially impacted in terms of boosting productivity levels as a consequence of artificial intelligence? Knowledge. The knowledge services sector is going to be probably the biggest beneficiary in terms of improved productivity. And the energy transition, we are the biggest consumer of that energy transition as a country, right? So I think, in an absolute sense, India sits at the crossroads of a moment in time, I guess. Maybe we'll look back at today's discussion 20 years hence and we say, well, that was on the 15th of January 2024. But you get my drift, right? I think there's a point in time today for India where it can afford to demand and command absolute levels of capital allocation based on fundamental value and merit.
Well, that's not controversial, that's music to the ears, Rishi. And to me, as we wrap up this conversation, the takeaways is this, more importantly, but also that things like private credit have come of age and might actually see some stupendous growth over the next few years.
Absolutely.
Thank you so much for your time. Lovely talking to you.
Pleasure, as always.
Yeah, and viewers, thanks for tuning in.